Welcome back to the Deep Dive, the show where we try to make the complex stuff clear and hopefully useful for you.
That's the goal.
So, we all know that feeling, right? Tax season is coming up, and maybe your income isn't just that simple W-2 anymore.
Right. Maybe you've got a rental property now or some royalty checks coming in. Maybe you're part of a partnership.
Exactly. And suddenly, taxes feel, well, less like filling out a form and more like, I don't know, some kind of high-stakes puzzle.
It really can feel that way. And the questions start piling up, don't they?
Yes.
How do I report this? Am I missing deductions? What about these losses?
Yeah, am I leaving money on the table? That's the big one. So our mission today is to cut through that confusion. We're doing a deep dive into one specific but really powerful IRS form, Schedule E, Form 1040. And this isn't just about, reading instructions. We want to help you see this form as a tool for you. Turn that confusion into, well, better financial decisions.
Precisely. We've gone through the official 2024 IRS instructions for Schedule E, pulled out the key stuff. The goal is to help you accurately report everything, sure, but also, crucially, to unlock those deductions, figure out the loss limitations, basically build a better blueprint for your finances.
By the end of this, hopefully, you'll see Schedule E not as a burden, but as a way to really optimize things, keep more what you earn. Sound good?
Sounds like a plan. Let's get into it.
Okay, so let's start right at the beginning. What is Schedule E, fundamentally? Why is it so important if you've got income beyond a regular paycheck?
Right. So Schedule E is basically the IRS's place for reporting income or loss from supplemental sources. Keyword there is supplemental. It's specifically for things that aren't your main W-2 job and also not a sole proprietorship business you'd report on Schedule C.
Ah, okay. So if I'm running my own consulting business, that's Schedule C. If I'm farming, Schedule F.
Exactly. But for these other streams, Schedule E is generally where you land.
Gotcha. So what kind of income streams are we talking about typically? What falls under this Schedule E umbrella?
It's actually quite a wide range. The big ones are rental real estate, and that includes personal property lease with the real estate, like, say, furniture and a rental.
Okay.
Then you have royalties. Think oil and gas, mineral rights, copyrights, patents,
Right.
even name, image, and likeness, NIL rights. That's becoming more common.
Right, NIL income.
Then income or loss passed through from partnerships and S corporations. That's a huge one. And finally, income or loss from estates and trusts, and even these more obscure things called RENICs, real estate mortgage investment conduits.
Wow, okay. That covers a lot of ground. So why is getting this right, putting the income on Schedule E versus somewhere else, why does that matter so much?
It matters hugely because the rules for deductions and how losses are treated are very specific to the type of income and where it's reported.
Sure.
Putting income in the wrong place could mean you miss out on deductions you're entitled to on Schedule E.
Or maybe take deductions you aren't entitled to.
Or that, which could lead to penalties. For example, the passive activity loss rules, which we'll definitely get into, heavily impact Schedule E income. How you categorize things directly affects your bottom line tax liability. It's not just administrative, it's strategic.
Strategic. Okay, I like that framing. Now, I noticed something in the instructions about attaching your own schedules if needed, as long as they follow the format. That seems flexible.
It is, relatively speaking. If you have, say, many rental properties or complex royalty streams, attaching your own well-organized schedule that mirrors the Schedule E format can make things clearer for both you and the IRS. It's a practical nod to complexity.
Makes sense. Okay, let's talk 2024 specifics. Anything new or particularly important reminders for this tax year that people dealing with Schedule E need to have on their radar?
Yes, definitely a few key things for 2024. First, a nice little bump for anyone using their car for rental activities. The standard mileage rate increased significantly. It's now 67 cents a mile.
67 cents, that's a good jump.
It is. So driving to check on properties, meet tenants, pick up supplies, that standard rate can add up quickly as a deduction.
Good to know. What about meals? Business meals always seem to be changing.
You're right, they do. The big change here is that the temporary 100% deduction for restaurant meals, that's gone. It expired. So starting January 1, 2023 and carrying into 2024, we're back to the standard 50% deduction for allowable business meals.
Ah, okay, so back to 50%. That's a common point of confusion, I bet.
Very common. Easy to forget that 100% rule was temporary.
Anything else major? I think I heard something about new loss limitations.
Yes, this one's important. The excess business loss limitation. It's calculated on a separate form, Form 461. If you report a loss on certain lines of Schedule E, primarily from rentals, partnerships, S-Corp, you might hit this limit.
Okay, so another potential limit on deducting losses. How does it work?
The tricky part is the disallowed loss isn't shown on Schedule E itself. After you figure it out on Form 461, that disallowed amount actually gets added back as other income on Schedule 1 of your Form 1040.
Wait, hold on. Added back as income. If I have a loss, why does it become income? That sounds backwards.
It sounds backwards, I know. But think of it this way. It's not eliminating the loss, it's deferring it. The disallowed amount, the part added back as income now, gets treated as a net operating loss, an NOL.
Ah, an NOL.
Right, which you can then carry forward to future tax years to offset income then. So it limits your deduction this year, but preserves it for later. It's a timing mechanism.
Okay, that makes more sense. A timing mechanism, not a permanent loss disallowance. That's a key strategic point. Any other new forms or opportunities for 2024?
Yes, for S Corporation shareholders, there's new Form 7203. This replaces the old worksheet you used to figure out your basis in the S Corp stock and debt.
Basis is crucial for S Corp, right, for deducting losses.
Absolutely fundamental. Your basis is the ceiling on how much loss you can deduct. So having this dedicated Form 7203 is intended to make calculating and tracking that basis clearer and hopefully more accurate.
More clarity is always good with basis. Anything else?
One more for property owners. If you have commercial buildings and you've made energy-efficient upgrades, check out Form 7205. It's for the energy-efficient commercial buildings deduction, also known as the Section 179D deduction. It allows you to potentially deduct costs for qualifying energy-efficient property you placed in service during the year.
Oh, nice. An incentive for going green with commercial rentals.
Exactly. It can be a pretty substantial deduction if you qualify.
Okay, so we've got the basics of Schedule E, the new updates. Now, let's zoom out a bit. Schedule E doesn't exist in a vacuum, right? What other forms or big tax concepts do people need to understand before they even start filling out Schedule E? It feels like everything is connected.
It really is a web, and understanding those connections is key to, well, getting it right and saving money. So depending on your specific situation with Schedule E activities, you might also need Schedule A, maybe for itemizing some non-business interest or taxes. Definitely Form 4562 for depreciation and amortization that's almost always needed with rentals.
Right, depreciation.
Form 4684 if you had a casualty or theft loss on business property. Form 4797 if you sold or exchanged business property. And then crucially, those forms for the loss limitations we're going to talk more about. Form 6198 for the at-risk rules, and Form 8582 for passive activity losses. These are huge.
At-risk and passive activity losses, got it.
Plus potentially Form 8826 for the disability access credit, Form 8990 for business interest limits, and Forms 8995 or 8995A for the qualified business income deduction, or QBI.
Wow. It really is an ecosystem of forms. What about those information returns, like 1099s? That seems like something people might overlook if they're just starting out as a landlord.
Absolutely. It's a common trip-up. If you, in the course of your Schedule E activity, paid someone $600 or more for services of someone who's not your employee, like a plumber or an electrician, you generally have to issue them Form 1099 and a T.
NEC for non-employee compensation.
Right. And similarly, if you paid $600 or more in rent, say for equipment, or royalties to someone, you generally issue a Form 1099 MISC. It's about reporting payments you make, not just income you receive. Compliance is key here.
Good reminder. Now, single-member LLCs, super popular, especially for rentals. How do they fit with Schedule E? Does having an LLC change things?
Generally, for federal income tax, a single-member LLC owned by an individual is treated as a disregarded entity. That means the IRS basically ignores the LLC structure for tax filing.
So, no separate tax return?
Usually not. The income and expenses of the LLC just flow directly onto your personal return. If the LLC's activity is rental real estate, it goes on Schedule E. If it's an active trade or business, Schedule C farming, Schedule F. It simplifies things by avoiding a separate corporate or partnership return unless you specifically elect to be taxed as a corporation.
That's really important clarification. Many people think LLC automatically equals separate return. Okay, now there's this term, qualified joint venture or QJV. Sounds potentially helpful. What is it?
Yes, the QJV. This can be a fantastic simplification specifically for married couples. If you and your spouse are the only owners of a rental real estate business, you operate it jointly, and you both materially participate.
Okay, lots of conditions there.
Yes, crucial conditions. But if you meet them, you can elect to be treated as a QJV instead of being treated as a partnership for tax purposes.
And the benefit is avoiding the partnership return.
Exactly. That's the main draw. Filing as a QJV typically doesn't change your total tax owed, but it lets you skip filing Form 1065, the partnership return, which can be complex and time-consuming. You just report everything directly on your joint Form 1040.
That sounds like a huge administrative relief for couples running a rental together. What are the catches? You mentioned crucial condition.
Right, the catches are important. First, the ownership. You and your spouse must own and operate it as co-owners,
Yeah.
not through a separate state law entity like an LLC or a partnership.
Oh, so if the rental is held in an LLC, even just by the spouses, no QJV.
Generally, no. That's a very common mistake. The property needs to be earned directly by the spouses as individuals. Second, both spouses have to materially participate in the activity. We'll talk more about what material participation means later, but it's more involved than just owning the property.
Okay, so direct ownership. Both materially participate. If you qualify, how do you report it?
You each report your share of the income and deductions separately on line 1 of Schedule E based on your ownership interest. So if you own it 50-50, you each report half. Then you just check the QJV box on line 2 for that property. Only one Schedule E needs the summary totals filled out.
And is this election permanent?
It's generally irrevocable unless you get IRS permission or, more commonly, you stop meeting the requirements, like if one spouse stops materially participating. But remember, QJV status simplifies filing. It does not change how self-employment tax or passive loss rules apply. Those still operate the same way.
Got it. Filing simplification, not a change in underlying tax treatment. Okay, quickly, before we hit deductions. Reportable transactions and Form 8886. This sounds purely like compliance stuff.
It is. This is about disclosing certain transactions the IRS considers potentially aggressive or abusive tax shelters, things like listed transactions, confidential deals, etc. There are also thresholds for large losses. The main point here is avoiding penalties. Failure to disclose these when required carries very stiff penalties, so it's about staying compliant.
Okay, stay compliant, avoid penalties. Now, the part everyone wants to understand better for saving money, the big four loss limitations. You mentioned these apply sequentially. Walk us through them. How do they impact deductions?
Right, this is where understanding the rules really pays off. Losses from rentals, royalties, partnerships, escort, etc. can be limited. These rules act like a series of gates, and you have to pass through them in order.
Gate number 1.
Gate number 1 is the basis rules. These apply specifically to partnerships and S corporations. Simply put, you cannot deduct a loss that's more than your adjusted basis in that partnership interest or S corp stock.
My basis is like my investment in it, right?
Essentially, yes.
Yeah.
It's what you put in plus accumulated income minus distributions and prior losses. So you can't deduct losses beyond your economic stake.
Makes sense. What happens to the loss I can't deduct because of basis? Is it just gone?
No, and this is the key tax-saving aspect. The disallowed loss is carried forward indefinitely. You can deduct it in a future year when you have sufficient basis again, maybe from more contributions or future income. The deduction isn't lost, just postponed.
Okay, postpone, not lost. That's good. Gate number 2.
Gate number 2 is the at-risk rules, handled on Form 6198. These apply more broadly: rentals, royalties, partnerships, S-corp, estates, trusts. The idea here is you can only deduct losses up to the amount you are personally at risk of losing in the activity.
What kind of money wouldn't be considered at risk?
Generally, non-recourse loans where the lender can only go after the property itself, not your personal assets, are not considered at risk, unless they're qualified non-recourse financing, which we'll touch on. Also, amounts protected by guarantees, stop-loss agreements, or money borrowed from someone who also has an interest in the deal or a related party.
Okay, so if I'm not truly on the hook for the money, I can't deduct losses against it. You mentioned an exception: qualified non-recourse financing.
Yes, this is a huge tax saver, especially in real estate. Qualified non-recourse financing is treated as an amount at risk, even though it's non-recourse. To qualify, the loan generally has to be secured by real property, borrowed from a commercial lender like a bank or certain government entities, and not convertible debt. This allows many real estate investors to deduct losses funded by this specific type of debt.
That sounds like a critical exception for real estate deals. And again, if a loss is disallowed by the at-risk rules.
Same principle as basis.
Yeah.
The disallowed loss carries forward indefinitely until you have sufficient amounts at risk in a future year. Deferred, not denied.
Okay, basis, then at risk. What's gate number 3? This is the big one, right? Passive activity losses.
This is definitely the one that gets the most attention, the passive activity loss, PA-owned rules, calculated on Form 8582. These apply to losses from most Schedule E activities, rentals, partnerships, S-corp, etc. The general rule is pretty strict. You can only deduct losses from passive activities to the extent you have income from other passive activity.
Passive losses offset passive income. Okay. But what is a passive activity?
Generally, it's any trade or business where you don't materially participate. And here's the kicker for Schedule E. Any rental activity is automatically considered passive by definition, regardless of how much you participate, unless.
Unless you meet one of the major exceptions. Limited partners are also generally considered passive.
Okay, unless. Those exceptions sound like where the tax-saving strategies are. What are they?
They are absolutely key. The first major one is qualifying as a real estate professional. If you meet the IRS tests for this status, your rental real estate activities where you materially participate are not treated as passive, meaning those losses can offset non-passive income, like W-2 wages.
Exactly, which can be a massive tax benefit.
Mhm.
Instead of being trapped offsetting only other passive income, those rental losses can reduce your overall taxable income
Yeah.
significantly.
Wow. Okay, what does it take to be a real estate professional in the IRS's eyes? Sounds tough.
It has two main tests, and you have to meet both.
Yeah.
More than half of the personal services you perform all year, across all your businesses, must be in real property trades or businesses where you materially participate. 2. You have to spend more than 750 hours during the year performing services in those real property trades or businesses.
750 hours and more than half your total working time. That's substantial.
It is. And if filing jointly, one spouse has to meet both tests on their own. But there's a helpful election. You can choose to group all your rental real estate interests together as a single activity just for testing material participation. That can make hitting the hours easier if you have multiple properties.
Okay, that election's a good tip. What's the other big exception, the one you hear about for smaller landlords? The $25,000 allowance.
Ah, yes, the $25,000 special allowance. This is a huge tax break for many people. If you actively participate in your rental real estate activities, you might be able to deduct up to $25,000 of rental losses against your non-passive income, even though rentals are normally passive.
Up to $25,000 against regular income. That sounds amazing. What are the requirements?
There are several key requirements you must meet. 1. Your rental real estate has to be your only kind of passive activity. 2. You can't have passive losses carried over from prior years from other types of activities. 3. Your net loss from the rental loss has to be $25,000 or less, $12,500 if married, filing separately. 4. You must actively participate in the rental activity. 5. Your modified adjusted gross income, MEGI, has to be $100,000 or less, $50,000 MFS. This allowance phases out between $100K and $150K MEGI, $50K, $75K MFS. 6. You can't be a limited partner or just a beneficiary.
Okay, that MGI limit is important, but actively participate, is that the same high bar as materially participate for the real estate pro status?
No, and this is crucial. Active participation is a much lower standard. You don't need to be involved day to day. You just need to participate in management decisions in a significant and bona fide way. Things like approving tenants, deciding on lease terms, approving repair costs or capital expenditures. You can even have a property manager handle the daily stuff as long as you retain that decision-making authority.
That's a huge difference. So many landlords who are involved in the key decisions could potentially qualify for this $25K allowance, even if they aren't spending 750 hours. That's a major tax saver.
It really is. It's probably the most widely applicable exception to the PL rules for rental owners.
Are there any other activities that just aren't passive to begin with?
Yes. Renting out a dwelling unit that you also use as a personal home under specific rules we'll get to is generally not subject to PL rules. Also, holding a working interest in an oil or gas well where your liability isn't limited is non-passive. And royalty income that's not from the ordinary course of a business, like portfolio income, is generally not passive.
Okay. And if, after all this, you still have passive losses you can't deduct?
Like the other limits, those disallowed passive losses carry forward indefinitely. You can use them in future years to offset passive income, or you can generally deduct all suspended losses when you sell your entire interest in that specific passive activity in a taxable transaction. Again, the deduction is preserved.
Reserved, just deferred. Okay, that's basis, at risk, passive activity. What's the fourth and final gate?
The fourth is the excess business loss rules we mentioned earlier, calculated on Form 461. This applies after the other three limitations have been applied. It's a final check on the total net business loss from all your trades or businesses, including pass-throughs reported on Schedule E that you can claim in the current year.
And any loss disallowed here?
Becomes an NOL carry-forward, same theme. Limits the current deduction but preserves it for the future. So it's a sequence: basis, at risk, passive activity, excess, business loss. Understanding that order is key.
All right, that foundation on the loss limits is critical. Now let's really dive into the nuts and bolts of Schedule E, Part 1. This covers rental real estate and royalties, probably the most common section for many listeners.
Absolutely. Part I is where a lot of the action happens. But before jumping into filling out lines, it's really important to know when you shouldn't be using Schedule E for rentals or royalties at all. Putting it in the wrong place can cause problems.
Good point. So when would rental or royalty income not belong on Schedule E?
Okay, several key situations. First, if you provide significant services to your renters, think services that are primarily for their convenience, like regular maid service, linen changes, maybe providing meals. If it operates more like a hotel or a bed and breakfast,
Then it's more like an active business.
exactly, then that income and the related expenses usually belong on Schedule C, not Schedule E. It's important to note, though, that significant services don't typically include basic landlord stuff like providing heat, light, collecting trash, or cleaning common areas. Those keep you on Schedule E.
That's a really important line to draw, especially now with short-term rentals. So hotel-like services push you to Schedule C. What else?
If you're a real estate dealer, meaning you hold property primarily for sale to customers in the ordinary course of your business, then income and expenses from those properties go on Schedule C too. Schedule E is for property held for rental income, not for flipping or developing to sell.
Makes sense. What about renting out personal property? Like maybe I rent out my RV or some tools.
If renting personal property is your main business, done regularly for profit, that's a Schedule C business. If it's more occasional, not really a full business, you typically report that income on Schedule 1 of Form 1040, not Schedule E. Schedule E is really geared towards real estate.
Okay, and farm rentals.
If you rent farmland and receive rent based on crop shares or livestock production, and you do not materially participate in operating the farm, you'd use Form 4835, farm rental income and expenses. But if that farm rental income comes via an estate or trust K1, then it lands back on Schedule E.
Interesting distinction. What about creators? Writers, artists, inventors getting royalties, or athletes with NIL deals?
For self-employed creators, their royalties are usually tied directly to their business activities, so that income and related expenses typically go on Schedule C. For student-athlete NIL income, if it's for services like endorsements or appearances, that's generally Schedule C income too, subject to self-employment tax. However, if it's a true royalty like licensing intellectual property and not tied to active services subject to SE tax, then it could belong on Schedule E. It really depends on the nature of the payment.
So the source and nature of the income dictates the form. Crucial first step. Okay, let's look at Part 1, lines 1 through 22. Line A just asks about filing 1099s.
Yeah, it's that reminder checkbox again. Did you pay $600 plus for services needing a 1099 NEC or rents royalties needing a 1099 MISC? Just a quick yes or no to confirm you're aware of those obligations.
Lines 1A and 1B, property info. Seems simple enough. Address, city, state, zip, and then a property type code.
Right. Line 1B uses codes, like 5 for land, 7 if you're renting property to your own business where you materially participate. That's a self-rental. 8's for other types. You just pick the code that fits.
Okay, now line 2. Personal use of dwelling unit. You flagged this earlier. This sounds like where things can get tricky, but also offer tax benefits.
This is huge. It impacts both whether you report income and how you deduct expenses. It's a critical fork in the road. First, you need to understand personal use. It's any day the unit is used by you, a co-owner, family members, even if they pay rent, unless it's fair market rent as their main home, anyone paying less than fair rent, or used under a reciprocal arrangement.
So letting my brother stay for a week counts as personal use.
Generally, yes. But there's an important exception. Days spent working substantially full-time repairing or maintaining the property don't count as personal use days, even if family's hanging out while you work. Also, days used as your main home right before or after you rent it out, or try to, for 12-plus consecutive months are generally not counted as personal use.
Okay, good exceptions to know. Now, the big test, the used as a home test, how does that work?
This is the key calculation. You're considered to have used the unit as a home if your personal use days were more than the greater of 1, 14 days, or 2, 10% of the total days it was rented out at fair market value.
More than 14 days or are 10% of rental days, whichever is bigger.
Exactly. And the outcome of this test dictates everything.
Let's break down those outcomes. What's the first scenario?
Outcome 1. Used as a home, rented for fewer than 15 days. This is often called the 14-day rule or the master's rule. If you meet this, it's fantastic.
Yep.
You do not report any of the rental income you received.
Don't report the income at all.
Nope. And consequently, you do not deduct any rental expenses like mortgage interest or property taxes on Schedule E. You can still deduct the qualified mortgage interest and property taxes on Schedule A if you itemize, just like for your regular home, but none of the rental-specific expenses. It's a simple tax exclusion for minimal rental use. Great for people who rent their home out for, say, a big local event once a year.
That's a really valuable, simple exclusion. Okay, what if you did use it as a home, but rented it for 15 days or more?
Outcome 2. Used as a home, A and D rented for 15 or more days. Here, you must report the rental income on line 3. But your expenses get tricky. You have to allocate expenses between personal use and rental use.
Allocate. How?
Usually based on the number of days used for each purpose. If you had 30 personal days and 120 rental days, total 150 days of use, then only 150 or 80% of your expenses like mortgage interest, property taxes, utilities, insurance, and depreciation would be potentially deductible on Schedule E. The other 20% related to personal use isn't deductible there. Furthermore, your total deductible rental expenses generally can't exceed your gross rental income for the year in this scenario. You can't create a loss from this type of property use.
So income reported, but expenses are allocated and limited to income. No loss creation. What's the third potentially best outcome?
Outcome 3. Not used as a home. This means your personal use was 14 days or fewer. A&D also 10% or less of the total rental days. If you fall here, you report the income, but you can deduct all your ordinary and necessary rental expenses. And importantly, your deductions can exceed your rental income, creating a loss, subject, of course, to those basis, at risk, and passive activity loss rules we discussed. This offers the most potential for tax savings through deductions.
That's crystal clear. Personal use is the absolute key to how rentals are taxed. Okay, line 3 is where you report that rental income.
Yes, gross rents received. And remember to include the fair market value if you received services or property instead of cash rent.
And line 4, royalty income.
Right. Gross royalties received, typically reported to you on Form 1099 MISC if over $10. As mentioned, sometimes patent sales or certain mineral disposals can get capital gains treatment check Pub 544. Report the gross amount, even if tax was withheld. You'll claim the withholding elsewhere on your 1040.
Okay, now lines 5 through 21. This is the expense section, the heart of the deductions. What's the overarching rule here?
Simple principle. Deduct all ordinary and necessary expenses paid or incurred for the rental or royalty activity during the tax year. Ordinary means common and accepted in the field. Necessary means helpful and appropriate. Big caveat. You can't deduct the value of your own labor, and costs for capital improvements aren't deducted here. They're capitalized and depreciated.
We'll get to that distinction. What about costs for making the property accessible?
Good one. There's a choice there. You can either claim the disabled access credit on Form 8826, or you can elect to deduct up to $15,000 per year of qualified expenses paid to remove architectural or transportation barriers. You can't do both for the same dollar, so you'd figure out which gives you a better tax result.
Okay, a choice between credit and deduction. Let's hit line 6. Auto and travel. Always a big area.
Definitely. Deduct ordinary and necessary costs. If traveling away from home overnight for your rental activity, you can deduct travel costs, including 50% of business meals. For car expenses specifically, you have that key choice again, standard mileage rate or actual expenses.
Remind us of the trade-offs.
Standard mileage rate, 67 cents a mile for 2024, is simple track business miles, multiplied by the rate, plus add tolls and parking. But if you choose it the first year you use the car for rentals, you're often stuck with it for that car. And you cannot deduct actual costs like gas, repairs, insurance, or depreciation if you use the standard rate.
Or actual expenses.
Right. Track everything, gas, oil, repairs, tires, insurance, registration, etc. Plus, you can deduct depreciation on the car using Form 40562, and lease payments, if applicable, reported elsewhere. It's more record-keeping but might yield a larger deduction, especially if you have high repair costs or an expensive vehicle. Crucially, if you claim any auto expenses, standard or actual, you must complete Part V of Form 4562 and attach it. Don't forget that step.
Form 4562, Part V. Got it. Line 10. Legal and professional fees.
Deductible if they're ordinary and necessary for managing the property or producing income, like fees for tax advice related to the rental, or fees for preparing that part of your tax return. But fees for defending title to the property, acquiring the property, or making improvements, those generally get capitalized into the property's basis and depreciated, not deducted currently.
Capitalized versus expense again. Lines 12 and 13. Interest expense. Often a huge deduction.
Yes, mortgage interest is usually significant. The key here are the tracing rules. You deduct interest based on how the loan proceeds were used. If you took a loan secured by the rental, but used the money to, say, pay personal credit card bills, that interest isn't a rental deduction.
So how do you make tracing easy and maximize the deduction?
Best practice, keep loan proceeds separate. Open a separate bank account just for the loan funds used for the rental property. Don't commingle. That makes tracing crystal clear and supports your interest deduction.
Smart banking hygiene. Any limits on interest?
Yes, potentially the business interest limitation on Form 8990 if your rental activity rises to the level of a trade or business, which is complex, and you don't meet small business exceptions. Disallowed interest carries forward. For reporting, mortgage interest from banks on Form 1098 goes on line 12. Other deductible interest, like seller financing, goes on line 13. Remember, points generally get deducted over the loan's life, not all at once.
Okay, line 14. Repairs versus improvements. You mentioned this is critical. Why?
Because it dictates timing. Repairs keep the property in good working order, but don't materially add to its value or prolong its life. Fixing a broken railing, painting a room, replacing a few shingles, these are deductible currently on line 14. They reduce your taxable income right now.
Versus improvements.
Improvements better the property, restore it significantly, or adapt it to a new use. Think a new roof, a new HVAC system, adding a deck, renovating a kitchen. These costs are not deducted currently. They're capitalized, added to the property's basis, and then deducted over many years via depreciation. Line 18. Getting this wrong means either missing current deductions if you capitalize a repair, or taking too much deduction now if you expense an improvement, which can lead to IRS issues.
Huge difference in tax impact. Okay, line 17, utilities.
Yeah.
But a catch for phones.
Right. You can deduct utility costs for the rental property. For telephones, you can deduct the cost of business calls related to the rental. But the basic monthly charge for the first phone line into your residence is considered personal and non-deductible, even if you use it for rental calls.
Good to know. Now, line 18, depreciation. The big non-cash deduction.
Exactly. Depreciation lets you deduct the cost or basis of your rental property, the building, not the land. And major improvements over a set recovery period, typically 27.5 years for residential rental buildings, 39 years for commercial. It recognizes that the asset wears out or becomes obsolete over time.
When does it start and stop?
Starts when the property is placed in service, basically,
Mm-hmm.
ready and available for rent. Ends when it's fully depreciated, you take it out of service. You absolutely need Form 4562 if you place property in service this year, or if you're depreciating listed property, like cars, or claiming Section 179, usually not for rentals, or amortization.
You mentioned land isn't depreciable, so if I buy a house on a lot, how do I split the cost for depreciation? This seems like a tax-saving opportunity.
It absolutely is. You must allocate the purchase price between the non-depreciable land and the depreciable building and improvements. You generally do this based on their relative fair market values at the time of purchase. Often, the property tax assessment breakdown can be a reasonable basis for this allocation if you don't have a formal appraisal. The more cost you can reasonably allocate to the building, the higher your annual depreciation deduction and the lower your current tax bill. It's a key step. Depletion, also on this line, is similar but for extracting natural resources like oil or minerals.
Smart allocation is key there. Line 19, other expenses, anything common here?
This is a catch-all for other ordinary and necessary expenses. Maybe professional association dues, bookkeeping software, travel costs not included elsewhere, bank fees for a rental account. Also, that Section 179D deduction for energy-efficient commercial property would factor in here, supported by Form 7205.
And then lines 21 and 22 are basically final checks for those loss limits.
Exactly. Line 21 directs you to Form 6198 if you have amounts not at risk. Line 22 directs you to Form 8582 for passive activity losses. Unless you meet that $25,000 special allowance exception, if you do, you calculate the deductible loss, up to $25K subject to MAGI, and enter it directly. It's also where you'd include prior year unallowed passive losses that become deductible this year. They act as final gatekeepers before you total things up.
Okay, we've thoroughly dissected Part 1 for rentals and royalties. Now let's broaden the scope to the other parts of Schedule E, starting with Part 2, income or loss from partnerships and S corporations. How does this work?
Part 2 is where information flows through from entities like partnerships, reported on Form 1065, and S corporations, Form 1120S. As a partner or shareholder, you'll receive a Schedule K-1 from the entity.
The K-1, that's the key document here.
It is. The K-1 details your specific share of the entity's income, losses, deductions, credits, everything relevant for your tax return. You take the relevant numbers from the K-1 and report them in Part 2 of Schedule E.
And those big four loss limitations we keep talking about, basis, at risk, passive activity, excess business loss, they're just as important here.
Absolutely critical. Maybe even more so, as basis and at risk are often the first hurdles for partners and S-Corp shareholders. You must apply these limitations in order to any losses reported on your K-1 before you can actually deduct them on Schedule E. It determines how much loss hits your return this year versus how much gets carried forward. Understanding these is paramount for anyone invested in these entities.
So if I had a loss from, say, an S Corp last year that got disallowed by the basis rules, but this year I have enough basis, how do I claim that old loss?
Good question. That's handled via line 27, specifically reporting prior year unallowed losses, or PYA. You report the now deductible passive losses or non-passive losses from prior years on separate lines in the appropriate columns, passive or non-passive, on line 28. You don't mix them with the current year's figures from the K1. This ensures you capture those valuable carry-forwards.
Okay, so track those carry forwards carefully. What about expenses I might pay personally for the partnership? Like maybe I paid for supplies the partnership agreement required me to cover.
Ah, yes, that falls under unreimbursed partnership expenses, or UPE, also reported separately on line 27. You can deduct ordinary and necessary expenses you paid personally on behalf of the partnership, but only if the partnership agreement specifically required you to pay them and they weren't reimbursed. And they have to be otherwise deductible business expenses. It's a specific but potentially valuable deduction if the situation applies.
Good niche deduction. Now, what about interest on loans I took out to buy my partnership interest or S Corp shares? That sounds complicated.
It uses those tracing rules again. You have to allocate the interest expense based on how the partnership or S corporation used its assets, business, passive, investment, or personal.
So I have to look through to the entity's activities.
Correct. If the entity used the funds that your contribution or purchase represents in an active trade or business, your interest expense is generally business interest reported on Schedule E. If used in a passive activity, the interest flows to Form 8582 to offset passive income. If used for investments, it goes to Form 4952 as investment interest. If traced to personal use by the entity, less common. It's generally non-deductible personal interest. It requires careful tracing based on the entity's operations.
Okay, that requires some detailed knowledge of the entity's finances. What about S Corp distributions? Do those go on Schedule E?
No, typically not. Distributions you receive from an S corporation are usually reported differently. If they're out of accumulated earnings and profits from when it might have been a C Corp, they're treated as dividends on your main form, 104-01010-0, line 3B. Distributions that are a return of your basis aren't taxed immediately but reduce your basis. Ordinary business income loss flows through on the K1 to Schedule E, but distributions are separate.
Got it. And self-employment tax. Big difference between S Corp and partnerships, you're right.
Huge difference, and a major planning point. Generally, your share of ordinary business income from a partnership is subject to self-employment tax on your personal return. But your share of S corporation ordinary business income that flows through to Schedule E is not subject to self-employment tax.
So S Corp status can save significantly on SE taxes compared to a partnership structure.
It often does. That's one of the primary drivers for choosing the S Corp structure.
Yeah.
Although there are other complexities like reasonable compensation requirements.
Right. Okay, moving quickly through the last parts. Part 3, estates and trusts, similar to partnerships, S Corp, K1 driven.
Yes, very similar process. You'll receive a Schedule K1, Form 1041, from the estate or trust, detailing your share of income or loss, which you report in Part 3. One specific note: if the trust paid estimated taxes on your behalf, that credit is claimed directly on your Form 1040, line 26, not netted here on Schedule E.
Okay, and Part 4, S real estate mortgage investment conduits. What's the key takeaway here?
If you hold a residual interest in a RIMIC, you report the income or loss from Schedule Q, Form 1066, in Part 4. The crucial thing is, RIMIC income or loss from a residual interest is not passive income or loss. It has its own set of rules. If you hold a regular interest, that's usually treated like a bond and reported as interest income on Schedule B, not Schedule E.
So residual interests are non-passive. Regular interests are like bonds, different treatments. It really highlights how specific the rules are for each income type on Schedule E.
Yep.
Okay, we have journeyed through Schedule E, the purpose, the updates, the crucial loss limits, rentals, royalties, partnerships, S Corp, estates, trusts, even RIMICs. Let's wrap up with some final thoughts, especially about something vital but maybe less exciting. record keeping.
It might not be exciting, but it's arguably the most important piece for actually realizing the tax savings we've discussed. Part V of Schedule E is just a summary section, really, though it does have a note about special estimated tax rules for farmers and fishermen. But the real foundation under everything on Schedule E is your records.
We always hear, keep good records, but connect it directly for us. How does good record keeping translate into actual tax savings or preventing problems?
Because your records are your proof. They are your defense if the IRS ever questions anything on your return. Without adequate records, receipts, logs, statements, deductions can be disallowed. Plain and simple. If you can't prove an expense was paid, was ordinary and necessary, or prove your basis or how you allocated costs, you risk losing the deduction.
So it's not just about being organized, it's about protecting your deductions and avoiding extra tax penalties and interest.
Exactly. Good records allow you to confidently claim every legitimate deduction you're entitled to. They allow you to accurately apply the loss limitations and track carry-forwards. They let you substantiate things like the allocation between land and building for depreciation or the split between repairs and improvements. It directly translates into minimizing your tax liability because you can prove your numbers.
What specific kinds of records should people be keeping for their Schedule E activities?
You need everything that supports the income and expenses. That means detailed receipts for all expenses, bank statements, especially for dedicated rental accounts, credit card statements, closing documents for property purchases and sales, insurance policies, property tax bills, invoices from contractors, canceled checks. For travel and auto, detailed mileage logs are essential. For income, keep copies of leases, royalty statements, and Forms 1099 MISC or 1099 NEC you receive. Keep records supporting your basis calculations and any carry-forward losses from prior years. Basically, document everything.
Document everything. It sounds like Schedule E, when you really understand it, is much more than just a form. It's a framework for managing the supplemental income and, really, a roadmap for finding tax savings.
That's a great way to put it. Understanding the definitions, personal use, material participation, active participation, repairs versus improvements, and navigating those loss limitations. It turns compliance into optimization. It's about being strategic.
Shifting from just filling out boxes to actively managing your tax situation for these income streams.
Precisely. Knowing the rules allows you to structure things, make decisions, and keep records in a way that maximizes your legitimate deductions and minimizes your tax burden over the long run.
So maybe what looked like just confusing tax jargon before now looks more like a set of tools you can use. The question for you, the listener, is, what new deduction, strategy, or record-keeping habit from this deep dive will you put into practice to gain a financial advantage?
We definitely encourage you to look at your own rentals, royalties, or pass-through investments through this lens. Are there opportunities you've been missing? Are your records strong enough to support your claims? Planning ahead with tax efficiency in mind can make a real difference.
We certainly hope this deep dive into Schedule E has brought some clarity and maybe even some confidence. Thanks for joining us on the deep dive. We'll explore another complex topic soon.
Until then, keep digging deeper.